ULTY investors are panicking. The ETF has dropped sharply, and social media is buzzing with fear. Is this the end for YieldMax's high-income star, or just another buying opportunity? In today's deep dive, we'll break down exactly what's happening, why ULTY is falling, and what smart investors should understand before hitting the sell button. Take a deep breath. By the end of this video, you'll know the full story, performance data, income strategy mechanics, risk exposure, and my research-based outlook for the months ahead. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. ULTY, or the YieldMax Ultra Option Income Strategy ETF, is part of the YieldMax family, designed to generate high monthly income using a synthetic covered call strategy on the Nasdaq 100. But unlike typical covered call ETFs like YieldTY or ULTY, ULTY adds a leverage twist. ULTY seeks to capture amplified option premiums by tracking a synthetic exposure to tech giants, think Microsoft, Nvidia, Apple, Amazon, then selling options against that exposure for income. Uses synthetic long exposure via swaps. Sells short-dated call options weekly. Payouts come from premium, not pure dividends. Dividends vary weekly, not fixed. This leverage and option overlay means massive income potential, but also higher volatility, and that's what's showing up in the recent crash. Let's look at what's causing the current drop. It's not random. There are three key forces at play. The tech pullback. The Nasdaq 100 has corrected as investors take profits in mega-cap names like Nvidia and Meta. Since ULTY's returns are linked synthetically to this basket, a tech pullback directly hits its NAV. Option premium compression. When volatility drops, option income shrinks. That means lower yields and reduced total return. Investors chasing income might sell when the payouts dip temporarily. YieldMax ETFs attract yield seekers, not always option experts. When prices drop or yields fluctuate, social media fear triggers emotional selling. But panic rarely pays in investing. Bottom line, the crash isn't unique to ULTY, it's structural. You're seeing the side effect of leverage plus short calls plus tech weakness. ULTY's eye-catching yields, often 60%, 70%, even 80% annualized, aren't magic. They're derived from option premiums that depend on volatility and time decay. That's why you can't compare ULTY's yield to SCHD or JP 101. ULTY's income is variable and may represent a return of capital during downturns. But even with fluctuating payouts, ULTY can remain profitable for investors who understand that its job is income generation, not capital preservation. When everyone's panicking, the pros are analyzing. Here's how experienced investors approach ULTY during drawdowns. Reassess risk allocation. If ULTY is more than 10% of your portfolio, that's risky. Diversify across SCHD, JP, or even TLT for balance. Reinvest dividends strategically. Reinvest during dips. Those reinvested payouts compound income power when prices recover. Track option premium health. Use metrics like implied volatility on QQQ as a leading indicator of upcoming yield potential. Avoid emotional selling. Panic selling converts paper losses into permanent ones. Income ETFs often rebound when volatility returns. Remember, ULTY's design means it thrives on volatility. If markets stabilize too long, payouts compress. If volatility spikes again, income surges. Let's compare ULTY to its YieldMax cousins and competitors. In the world of ETFs, various strategies cater to an investor's appetite for risk and yield. For instance, ULTY offers a high yield with leveraged covered calls, targeting those comfortable with significant market fluctuations. In contrast, JP focuses on providing income with protection, catering to more conservative investors seeking lower volatility and stable returns. Each ETF presents distinct characteristics tailored to different investor profiles. ETF strategies vary extensively, each serving unique investment needs. For instance, YieldMax combines S&P 500 exposure with covered calls, aiming for moderate yields while balancing risk. Alternatively, MSTY takes a more aggressive stance with MicroStrategy, showcasing extreme volatility and targeting maximum returns, appealing to thrill-seeking investors. The diversity of ETF strategies, from leveraged high-yield options like ULTY to stable income-focused choices such as YieldTY, highlights the importance of aligning investments with personal risk tolerance and financial goals, ensuring that every investor can find their ideal path to growth. Compared to YieldTY or SCHD, ULTY is like a sports car, fast, loud, but not for every driver. It's built for traders seeking income acceleration, not slow compounding. However, when used as a small allocation, say 5% to 10%, it can meaningfully boost portfolio yield without wrecking stability. Price correction may stabilize around recent support levels. Yield likely to recover as volatility rebuilds. Future distributions depend on Nasdaq 100 momentum. If QQQ rebounds or volatility spikes due to macro uncertainty, ULTY could see its next high-yield wave. But don't expect smooth sailing. Option ETFs like ULTY are inherently bumpy. The trick is managing position size and expectations. If you hold, focus on total income received, not just price chart fluctuations. So, should you sell ULTY? Not necessarily. You should understand it. If you bought it for stable growth, this isn't your ETF. If you bought it for high income and can stomach volatility, the current panic may actually be opportunity. YieldMax funds aren't broken, they're behaving exactly as designed. The question is whether their risk profile fits your strategy. Don't let fear drive your financial decisions. Let knowledge and risk management do it. Thanks for watching this in-depth breakdown. Subscribe if you want real analysis, not hype, on ETFs like ULTY, MSTY, YieldMax, and beyond.